Hey, welcome back to You Heard It from CFP. My name is Matthew Coyle. I'm the Director of Financial Planning here at ACG in Minneapolis, Minnesota. We're going to talk about a very interesting topic today that is kind of near and dear to my heart, why you cannot wait for the Federal Reserve and the markets to give you the all clear to start investing again. I know it's been a very, very tough 12 to 15 months for investors, as we have all seen. If you've opened up your retirement statement recently, you probably just wanted to put it back in there and send it back. However, don't do it. Keep investing. In fact, you should probably get your knives out and get your lists out and start investing a little bit more. Why? I'm going to tell you with a little trip back in time and history lesson. I'm going to make this very brief but very interesting for you on episode 60. Thanks. Well, we start episode 60 off today with taking a brief trip back in time for maybe a little informative history lesson on how you as an investor should look at the current time periods of today and maybe take some lessons from it or draw some inspiration from it perhaps. So let's take a look at that, and let's specifically go back to 1979 through 1982. The 70s and 80s, of course, especially the late 70s and early 80s, not the best time economically for the United States if you're objective about it, but let's go back and take a look at what lessons that time period might have for today's investors, given some reasonable assumptions and just looking at some reasonable metrics and applying that today and figuring out what you should do with your money. And I know it's been a tough 12 to 15 months. For many investors, it has been a grinding last year or even year and a half. Markets have not been friendly. As we've documented on this video series in the past, the worst by many measures, stock and bond combined performance ever. In my opinion, this will not continue. This mathematically is very unlikely to continue, but we can talk about that in other videos. Today we're talking about a history lesson and what we can use in the past to apply to today's lessons as investors, and why specifically you should not wait for the Federal Reserve and the markets to signal the all clear for you to get your money working again. Now is the time to be investing. You need to be doing it regularly and very quickly, in my opinion, but we'll talk about that in a second. First, let's go back to 1979 and a man named Paul Volcker. All right, well, who is Paul Volcker and why should you care about him? Well, Paul Volcker, as some of my more experienced viewers may know, was the chairman of the Federal Reserve from 1979 through 1987. But it was his performance in the job between 79 and 82 that made him one of the more notable chairmen in the history of the Federal Reserve. Of course, the Federal Reserve chairman is one of the most powerful people in the world if you really think about it economically. And economically, during that time period, the United States was in a bit of a rut. Interest rates were extremely high, inflation was extremely high, mortgage rates were extremely high, homeownership had dropped, economic malaise was upon us, and Paul Volcker came in with a very, very simple mandate. Whip inflation and whip it fast. And that he did. Now, as a result of that, and there are some parallels, of course, to today's economy you may already start to notice, as interest rates rose, the stock market fell and fell precipitously and in a grinding way from November of 1980 until August of 1982. In fact, between that time period, between November of 1980 and August of 1982, the market fell as measured by the S&P 500, largest cap stocks in the country at the time. As measured by the S&P 500, the market fell over 27% from November of 1980 through August of 1982. It was a grinding period that, in fact, for many retail investors, the average mom and pop investor, caused them to swear off stocks completely. It was a very, very difficult time period for investors, not fun. Bonds did poorly, stocks did poorly, pretty much everything did poorly. But the stock market particularly took it on the chin with almost a 30% loss as measured by the S&P 500. But then things changed, and let's look at that now. So, by August of 1982, many retail investors had sworn off stocks altogether. They were done putting the next penny into any investments that was related to the stock market. However, things were about to change. In August of 1982 through November of 1982, after a grinding nearly 2 years of losses that saw people's accounts wiped out by nearly a third, in many cases more than that, depending on what you were investing in, stock market as measured by the S&P 500, of course, went from, in August of 1982 to November of 1982, returned 34% to investors during that time period, and then promptly went to new highs. Now, the interesting part about this is those who were waiting for the Federal Reserve found themselves quite disappointed. Paul Volcker, who was very adept at using communications with the public and using communications within the industry to signal where the Fed might be going or what shifts might be coming in interest rate policy, did not even start mentioning a Federal Reserve pause or Federal Reserve decrease in rates until October of 1982. Now, what happened after that? The market promptly hit all-time highs. Between August of 1982 and November of 1982, the market erased all of the losses from the preceding 18 months to 2 years and promptly went on to new highs, and unbeknownst to many around them, the new bull market from 1982 to 2000 had begun. And it came in a fury, and if you waited around for the Fed to give you the all clear, you missed it. You would not have been fast enough to make that market. So what lessons could we take, or what instructional value could we take from the 1979 to 1982 period that we could apply to today's market? Well, like then and now, we have a very, very, very rapid rise and increase that's causing stock prices to fall. Why are they falling? Because stocks are basically discounting mechanisms. They are future values discounted to present values. If a growth stock, for example, has future earnings in the future, and those need to be discounted to the present to get a value of the shares, a higher discount rate, a higher interest rate, acts as a higher discount rate. You're dividing by a bigger number. The share price, which is the result of that, has to go down. So higher interest rates do affect stock prices quite negatively. However, periods of rising inflation are relatively short. They don't last very long. And when the market starts to anticipate the change, like it did back in 1982, this is very analogous. When the market starts to anticipate that change, you need to stay invested so that when that change happens, the market's going to move fairly quickly. They typically do. And finally, let's do one more comparison to the 1982 market that might be worth mentioning, and that is a little thing called valuation relative to free cash flow. Well, what do I mean by that? What I mean by that is the following. Every company calculates their free cash flow, or FCF. Free cash flow is the measure of how much cash a company has after paying all of its internal and external obligations. Well, what does that mean? It means that after all the bills are paid, the employees have their payroll checks, and all the expenses are paid, it's basically the amount of money that's left over to pay dividends to shareholders or repayment to creditors or whatever. It's the free cash flow of a company after all internal and external obligations have been satisfied. When you value a company, for example, you can value their share relative to the free cash flow of the company. Back in 1982, the free cash flow valuation of the S&P 500 was roughly 16 to 17 times free cash flow of the index. That same number today, and that was at the bottom of the bear market, that same number today, according to Morningstar, forward earnings, about 10 or 11 times. So companies today are trading at a cheaper valuation to their free cash flow, which in many ways is could be the most important metric of any company, is how much cash is left over after you've paid all the bills. Companies today are trading at a cheaper valuation than they did even during the bear market of 1982, which is actually quite astonishing because that was a punishing period. So, very, very interesting. We've just come through a very painful period of rate increases. Stick with it. You never know when the market's going to turn. It can turn on a dime, just like we saw back in those days. And if we do get a pause in rates or some type of pause from the Federal Reserve, can't guarantee it, but when you do, and when that happens, the markets typically move very aggressively, very quickly, and in your direction. So stay invested as long as it's within the confines of your financial plan. I wish you the best of luck, as always, of course. Your most valuable asset, and I always say this every time, is your time, okay? Spend it wisely. Thank you for spending some of yours with me. I'll see you next time, and thanks.